In continuation to class 4.3, today's class 4.4 intends to discuss about a new theory of capital structure. The new theory which we are going to discuss is traditional theory of capital structure. Traditional theory of capital structure was suggested by Solomon Ezra. Actually, this is a midway or compromise between net income theory and net operating income theory. As it is a compromise between net income theory and net operating income theory, traditional theory is commonly known as intermediary approach to capital structure. According to this theory, the weighted average cost of capital can be decreased and the value of the firm can be increased initially by using more debt. Thus, an optimal capital structure can be achieved by a proper mix of debt and equity. But this is possible up to a certain level only. Beyond a particular level, the increased debt will increase the financial risk of equity shareholders, and consequently, the cost of equity will be increased. In other words, beyond the particular level, the benefit of cheaper debt is offset by increased cost of equity. So, we may conclude that the traditional approach suggests an optimal capital structure, but the quantum of debt should not exceed a particular level. Under this method, the value of firm is computed by adding market value of equity and market value of debt. Market value of equity is found out by capitalizing earnings before tax by the cost of equity. Okay, now let us see how the increased debt in the capital structure of a firm affects its value. The question is, compute the market value of the firm, value of shares, and the weighted average cost of capital from the following information. Net operating income rupees 2 lakh, total investment rupees 10 lakh, equity capitalization rate if the firm uses no debt 10%, if the firm uses rupees 4 lakh debentures cost of equity or equity capitalization rate is 11%, and if the firm uses rupees 6 lakh debentures equity capitalization rate is 13%. Assume that rupees 4 lakh debentures can be raised at 5% interest, whereas rupees 6 lakh debentures can be raised at 6% rate of interest. Okay, this is the question. Then let us find the solution. Here we have to find the market value of shares, market value of firm, and weighted average cost of capital in three situations. So we may begin with the net operating income or EBIT, which is given in the question. Net operating income or EBIT is rupees 2 lakh in each case. EBIT or net operating income is 2 lakh in each case. Then subtract interest on debt to find earnings before tax. In the first case, there is no debt, and therefore there is no interest on that. But in the second case, there is debenture worth rupees 4 lakh having an interest rate of 5%, and therefore total amount of debenture interest is 20%. And in the third case, there is debentures worth rupees 6 lakh with an interest rate of 6%, and therefore total amount of debenture interest is 36,000. So we get earnings available to equity shareholders or earnings before tax rupees 2 lakh, rupees 1 lakh 80,000, and rupees 1 lakh 64,000 in the three situations. Okay, and the cost of equity given in the question is 10%, 11%, and 13% in the three alternatives, and therefore we may capitalize this earnings before tax by the cost of equity, and when we capitalize at by cost of equity, we get market value of equity share capital, that is 20 lakh in first case, 16 lakh 36,364 in the second alternative, and in the third case, the market value of equity share capital is 12 lakh 61,538. And then we add the market value of debt to this market value of equity share capital, and the debt is zero debt in first case, 4 lakh in second case, and 6 lakh in the third case. So we get the market value of the firm as rupees 20 lakh in first case, and 20 lakh 36,364 in the second case, and the market value of firm is 18 lakh 61,538 in the third case. Students, examine the market value of firm in three alternatives very closely. Here it is 20 lakhs, and in the second case it is 20 lakh 36,364, and in the third case 18 lakh 61,538. Okay, the market value is 20 lakh. You see, here there is no debt. Okay, when there is a debt of rupees 4 lakh, market value of firm increased to 20 lakhs 36,364. Again, debentures or debt to capital increased to 6 lakh. In this case, the market value is reduced to 18 lakh 61,538. This is the impact of quantum of debt in the total market value of the firm. Now let us see the weighted average cost of the firm. The overall cost of capital is 10% in first case. That means when there is no debt, the cost of weighted average cost of capital is 10 percentage. When then there is a debt of 4 lakh, it is reduced to 9.82%. But when it is increased to 6 lakh, the cost of capital, weighted average cost of capital, increased to 10.74%. Students, I hope that all of you have got a clear picture about the traditional theory of capital structure. And so let us wind up the class 4.4 here. Prepare all the notes and study well. Thank you very much.